and welcome to the fifth episode of Finance Ke Funde. I am Shruti.
And I'm Vikash. Today we'd like to discuss about tariffs and tariff war, which has been impacting each one of us.
So let us start with the basics of what is a tariff and a tariff war. So tariff is nothing but a tax which is imposed by a country when they are importing something from some other country. Now, technically, tariffs are normally imposed to encourage production within the country and reduce our dependency on imports. But we've also seen that often any tariff story quickly escalates into a tariff war situation.
So, see what happens is that if you see about tariff, if you see the global economy, what happened is that post 1930, what we are seeing is that the world was opening up and there was a spree of globalization after depression, and low value things which were expensive being done in some country was getting outsourced to other countries, and this is how the global economy was shaping up. But in 1970, US, which was one of the biggest exporter, what happened is that there was a shift which happened, that US, which had a trade surplus, started having trade deficit. Now, being a reserve currency, it was not having any problem, but this trade deficit started increasing. And now what was happening is that a lot of manufacturing which was happening outside was becoming a major part of US for their imports, and they were not exporting as much. Because of this mismatch of exports and imports in the US economy, what we are seeing is that US is trying to negotiate hard with other economies, and it is saying that we'll impose tariffs on the stuff that you export to us, and if you are not obeying that, then what will happen is that we will penalize you. There is another option that you have to charge us less for our exports. So this is a war which is happening to balance out the US trade deficit.
So because you mentioned about 1930 when US had started imposing tariffs, and if I remember correctly, the other countries had also started retaliating by imposing their own tariffs, very similar to the situation that we are seeing right now. And we remember that the result of that whole imposition of tariffs and retaliation was very catastrophic. It was a complete breakdown of trade globally. So we know that these kind of situations, if there is no harmony in these discussions, it can quickly escalate to a trade war situation. So how is a trade war different from a tariff war, and what are some of the ramifications that you see can be possible if we land up in a trade war kind of a situation?
See, what happens is that whenever we are thinking about any economy, every economy wants certain kind of things, because everyone, like any individual businesses also, everyone has their own competitive advantage and they would like to function on those advantages. But when there are tariffs, because of tariffs, what happens is that your competitive advantage goes down. So let's take an example. Say suppose US, which is very good in manufacturing, not manufacturing, they're very good in technological advancement on iPhones. So what they are doing is that they are creating those IPs within their country, and the job which is more like manufacturing, which is more labor intensive, assembling, that they're outsourcing it to other countries. Now, what is the impact of this? The impact of this is that the price of iPhones becomes more competitive, because you are able to outsource your low skilled or low value adding jobs to other countries. The other countries have labor advantages, so they take over this, and this has an implication of the consumer ultimately benefiting out of it, because you are getting things cheaper. Now, if a tariff is imposed, what is the first order effect? The first order effect of a tariff is that let's take the example of iPhone only. Say suppose they impose more tariffs on the products which are being manufactured from China or from India. That product, when it goes to US, will obviously increase the prices of iPhone. Now, as an iPhone manufacturer, as an iPhone business owner, you have two choices. Either you pass it on to the consumer, or you absorb it.
So either your profit goes down or the price goes up.
So now this is just an impact on one individual business. Now, if you see that this gets impacted on other businesses as well. So every business, if say suppose it is seeing like lack of margin, or the price is getting incrementally passed on to the consumer, this creates a lot of inflation in the economy, and this kind of inflation creates more kind of tariff that you put on a retaliatory basis. Now the competitive edge of the economy goes down gradually. So when a tariff is imposed in, like, we are seeing tariff in various industries, right? India also has some industries where there is tariff. But when this escalates to such a level that the global trade hampers to such an extent that consumers are also getting affected, businesses are also getting affected, this leads to complete breakdown of trade between countries. And that also leads, see, what also one thing I personally think is that trade is also a means through which two economies are friendly with each other. Because if you don't have any economic interest between two countries, the chances of you becoming unfriendly increases. So a tariff war, when it escalates to trade war, can also escalate to other things also. So this is how this escalation of tariff to trade war to other kind of scenarios gets developed.
So when you think about it as a, as a person governing a country, the idea of encouraging domestic production sounds very reasonable. We have been talking about Make in India for so long. When Trump came in, he started talking about making America great. So, which is what led to the whole tariff communication. So, I mean, at what juncture do we see that it is reasonable to have domestic production as well as have a balance in external trade? Because the way the communication started, it was obviously not very friendly. And we have seen that things, while there is a 90-day pause currently, things haven't really resolved with a lot of countries. Even China is currently speaking to the US, India is speaking to the US, but there is still risk lurking around, right? So what is your view on how could this be approached going forward?
So see, I think that even the people who are the policymakers in US, maybe Trump and other people, they also know that this cannot be solved immediately. But if you see, what was happening is that there was a status quo which was happening with US. And US being a net importer, most of the countries were okay with the present policies. They had some high import duties for goods coming from the US, and they were enjoying some like advantages when they were exporting to the US. So I think the present idea from the US administration is to bring people on the talking table. So the last 5-10 years, people are not talking because ultimately you are someone who is a net exporter, and US being one of the biggest consumption economies, everyone was benefiting out of it. So with this kind of rejig, what he has done, there may be some people who economies will now try and discuss. They will also budge a bit because nobody would want to lose access to the US markets. But this will also have some second order effects which we also don't know, because if you are trying to push this thing too hard, and if you want complete protectionism where you will say that everything will be manufactured in US, then you being a reserve currency will have some higher implications. So we'll also have to see how does this shape up. But I personally feel, given what we have seen in the last 40-45 days, what we saw is first level where the tariffs were very, very high. Then he also gave a 90-day window, which is more about trying to negotiate things out. In that, he had reduced the tariffs for some countries. The countries where he wants to negotiate hard, there the tariffs are slightly higher. So this looks more like to find a middle path and maybe get some your trade deficit, bring it down to some extent, which is a very dangerous level for US right now.
So you also mentioned that US being the reserve currency holder, if they push this too hard, it's going to have implications, which is second order, third order effect. So do you want to talk more about what possible currency impact can be there, which can trickle down to other economies as well?
This is actually a very, very difficult topic. I was reading one article by Warren Buffett also. So he said that it's very easy to say that US will lose its reserve currency status. It will, and if at all it happens, it will be very, very, very gradual. The reason why he was saying this is that the world owns their savings in US dollars. So if you see, most of the economies are having either US debt, which they own, maybe US securities in terms of US equities or US real estate. So these are the ways in which they are owning this US kind of assets. Now the only way out for them to not own this US debt is that US buys these things from them. by this what I mean is, say suppose until and unless US becomes a net exporter, how will you dislocate these assets that you own? So this is not very easy. The other way out is that the US dollar depreciates a lot. So I think the US dollar losing its reserve currency status has been discussed maybe in the last 10-20 years, but I don't think so. We still have a alternate currency situation, plus the kind of acceptance US dollar has across the globe. It's not very easy, but definitely we are seeing some signs of a gradual decline of US acceptance. So gold being bought more by other economies, and like there are other things like people are trying to negotiate deals in their own currency. Some development is happening, but I think it will be very, very gradual, and I don't think that this is something which is in a very, very near term future.
So even though we are talking about second, third order effects, some of these effects could be over a very long period of time. And this could probably become a case study of how a certain economic activity led to so many other events in the future. But let's hope we don't get to that. So we know that let's talk about India, particularly about and India being in this situation, and we know that the mood between US and India was not as unfriendly as maybe between US and China. So there was some room for negotiation. India was one of the first countries to go to the table and talk to the US. So what do you think will be the effect of these tariffs on India? We are very close to the 90-day window getting over now. I don't think we have come across any credible news as to where we are with the trade pact being signed. So where do you think the impact is on India, both on the economy and also on the stock markets?
So see, what I think is that whenever this is a clear case of negotiation between two countries, okay, and India being a growing economy plus the domestic demand that India has, no economy worldwide will want to upset us also. So when you are in that kind of scenario and in a negotiation framework, you always have that advantage with you. Say suppose there is a smaller economy, they may not have that kind of advantage, but being a bigger economy, having a runway which is 10-20 years ahead, so in this negotiation between every country we'll have some kind of advantage. We saw that advantage play out with our deal in UK, like when we see the deal, so there are certain things where we'll be benefited, and this was long standing. So this overhaul of tariff which has happened will actually help us strike some good deals also. Even on the markets, if you see, we are seeing that the markets are also seeing that this China plus one thing also will play out. So whenever a status quo is challenged, people now start thinking about how do I diversify, how do I reduce risk. And we not being a very, very big exporter right now, we may actually get benefited out of it. So my view is that on a net basis, India should benefit out of this tariff discussion, given that we are not a very, very big exporter. Given the government is also pushing for manufacturing facilities in India, they are giving a lot of SOPs to people who are setting up manufacturing facilities. On the stock market, see, if you see the numbers, like the exports to US is not something which dominates our economy. So it is a very, very small percentage of our GDP and even on our exports. So the markets, after that uncertainty, has taken it by its stride. And I think markets also is realizing that there would be a deal which we should strike. And if you see the emerging markets, we are one of the best performing emerging market after this trade war. So I think net India should be benefited. But what happens is that still we are not an isolated country. So if there are global shocks, all those kind of events, we'll have some short-term kind of reactions in the market. But if you think about 3-4 years, I think on an economy basis, we should be net positive.
Yep. So we have seen that, when tariffs were announced in April, the markets did react very negatively, even though the data that you are talking about shows that we are not as bad in this whole situation as other countries. So I think it's more of a uncertainty and a sentiment-driven, movement that we see in the markets. But overall, we might actually show some resilience unless there are some global adversities. You also mentioned one thing about India benefiting from the China plus one ideology. Now, from the recent news, we also learned that the US is getting softer on the higher tariffs that they are wanting to impose on China. China has come to the table. There's been no conclusion to that effect. But let's say there is a good deal that US and China is able to strike. Then do you think we lose out on this whole benefit of China plus one?
So see, I think let's take two scenarios. First scenario is that when a trade deal is being done between India and US, and the US and China, we both are at the same level of taxation, like on the same level of tariff. Even in this case, I personally feel, given that there has been an overhaul and people realize that there is a risk, people will want to diversify. So even in a same kind of taxation environment, there is a lot of trigger around diversifying from China. So a trickle down effect of that would be that they would be looking at countries who are like politically stable, who have those resources. So India has a chance on that scenario also. Plus, we also know that given the kind of trade deficit US has with China, with India it's not that big. With China it's even bigger. So there is a high probability that the China tariffs can be higher than India. Then that is an added advantage. So I personally feel that this overhaul of tariffs which has happened will have some kind of positive effect on India. Plus, even the Indian government is realizing it and it is trying its best that some kind of like incentives are given for people who take this manufacturing. And even in various discussion forums, if you see that a lot of ministries are talking that we have to take this advantage. So I think that in the next 2-3 years, we'll have some global supply chains which will initiate from India in a greenfield way.
So because I can see three possible scenarios that we can look at when we talk about these tariffs. The best case scenario is that the tariffs are reduced, the tensions ease, and the markets bounce back. This looks highly unlikely, especially in the light of the tweets that Trump has made for Apple specifically. The middle scenario is that some tariffs get reduced, some stay. It is partially negotiated with different countries. So we will see pocketed positivity and pocketed negativity. I think that is a more likely scenario. And the worst case, of course, is that the negotiations fail and we just enter into a proper trade war situation, which is bad for all economies and all equity markets in general. So I feel that the middle scenario is more likely of panning out over the next few months. What is your take on it?
So I think I completely agree with you, Shruti. Like what you are trying to say is, I second your thoughts. We may not see the best case scenario playing out because see, we have seen Trump administration in 2018 tenure, right? So he is someone who will always try to twist things in such a way that it is more beneficial for him. And we see that happen again and again. And markets don't like uncertainty. And he is someone who always triggers some kind of uncertainty. So one has to be slightly more, I think, reasonable with his kind of administration from the US, that there will be some uncertainty which will be coming our way. The middle ground for us looks more likely to me because of our domestic demand. And even if you see, the government is trying to push growth. So the RBI has reduced interest rates. There is also talks that the government wants to do more like fiscal spending on defense, on other aspects. So we will see that the domestic economy doing the heavy lifting, and the trade deals that we'll have, that will add to the growth of our economy. And even on the worst case, I don't think so that shaping up. Again, I am taking inference from what has happened in the last 45 days. So the discussion is more about negotiation, like I told you earlier, rather than trying to escalate it. But we should never ignore, we should not be 100% confident that it should not happen. But I would say there's a high probability that the worst case scenario will not happen. And we may see a middle ground where we'll see some tweet coming from Trump about something, and again uncertainty in the market. Like you said, like Apple, he said that I don't want Apple to produce in India, China, or I'll ask more tariff from Apple to sell in US itself. So these kind of scenarios which he is creating obviously is hated by the business community and even from the stock market community. So we'll have like pockets of volatility. But at the end, I see that the economy should still be doing reasonably well in the next 2-3 years, and we'll have that benefit play out in the stock market.
And you also mentioned about markets not liking uncertainty. So one thing that is coming to fore is if the Trump administration is in power, buy gold. So we have seen a wonderful run up that gold has showcased over the last few years. Do you think that it continues to be in favor? Should investors still continue to buy it for their portfolios given the uncertainty is still not over?
Yeah, I think, see, what happens is that we have been talking about gold, I think, Shruti, since last 1.5 years. So it's not that we are not saying that we should not invest in gold, but with gold also you have to think it more of a long-term asset allocation kind of instrument. And if you're thinking it on those lines, where you're not trying to time the purchase in terms of the best price movement, but you're trying to allocate it for your asset allocation perspective and to serve a purpose when a risk plays out. So if you're thinking on those lines, you should build gold exposure at these levels. Obviously, you should not do any kind of lump sum, or you should not go overboard on gold just seeing the trading returns for the next 1 year. You should see that, if you should be aware as an investor that if this geopolitical tension eases out and if this trade war also is at a subdued level, we may see gold returns also pause for the next 1-2 years. So there's a lot of return that has already happened and a lot of events are also behind us. So you have to be cognizant of this fact. I would say that anybody who's looking to, say, build 10-15% of their assets in gold, which is linked to US dollar, which also helps you price some of your net worth in a currency which is other than India, then you should always think to build it gradually. So if you are at 2%, you can first think that by next year I'll go to 5% or 10, you can stagger it. So that is the view for gold that I have.
And on the equity market perspective, a lot of investors talk about being scared of volatility and being in this uncertainty they don't want to invest. So what do you have to say to investors? And given we have seen a bear market, we have seen volatility over the last few months, and a lot of people who have capability to invest are sitting on the edge thinking that there is volatility and what is the right time to enter the market. So what do you think about that?
So again, see, if you see the last 1 year returns of the market, they are very, very subdued and earnings are growing at, say, 9%. So we are seeing a time correction play out and the valuations are actually cooling off. So if you are thinking that you will get a lot of downward opportunities to buy at downward levels, I don't think so that will happen, because we have a lot of uncertainties behind us. But if you think that there will be no volatility, that is also not there. So these are times where you should aggressively build month on month. So if you are having any surplus, you should not hold back to put in the markets, because the markets are not extremely at levels which is very, very euphoric. Obviously, it is rightly priced, and if you're thinking about 3 to 5 years building your equity allocation, these are times where you actually, because you don't get these kind of time correction periods also a lot of times in the market, because if you think that after 1 year, if the market again starts going up, then you will again be buying on an upward trajectory. So this is the time where you actually build your equity exposure. There would be some interim volatility that you have to take by your stride. And you have seen that even with the India-Pakistan scenario, the markets were showing strength. So we are seeing that the markets are at levels where there is some investor interest is there. FIIs are also coming back. So my personal view is that you should not put everything in the market right now, because obviously the time is not something where the valuations are very, very attractive, or it's at sell your house and buy equity. But a gradual allocation is definitely warranted at these times.
And I think one of the problems with just holding cash back and waiting for the right time to enter is that if at all there is recovery in the market, let's say we see a 5% up move in the indices, you don't know whether that is a temporary up move or that's a start of a rally. And at that point, taking the decision कि अभी डालना है या अभी और wait करना है, it might go down, there is still uncertainty. Most of the time, we just miss out on that entry point. We continue to sit on cash and वो और ऊपर चला जाता है, and then we realize कि okay, this is the start of the rally and we have already missed the bus. So I think that is a very, very tough call. Technically, we are trying to time the market if we do that, or we are trying to say that we know for sure that markets will go down or there will be volatility. For anybody who wants to invest purely in stability, they have to understand that you can only invest in stability in a bull market. Any time else, I feel it's always a little bit of a leap of faith that you take with the markets as well. So I think that's it from our end on the global tariff war. We hope that this has been useful for you, and do stay tuned for our next episode. In case you like what we talk about, do subscribe to our YouTube channel and share as much as possible. Thank you so much.